Good afternoon, and welcome to the April version of Making Sense of the Markets with Chris Kerlow and Team LWC. Thank you to everyone for taking time out of your day to join us. If you have any questions during our presentation today, please write them in the chat, and I will ask them to Chris if they are timely. Otherwise, we will get back to you directly or address it in our next MSOM. This month's edition is titled Too Hot to Touch, where Chris will walk us through the latest on the markets, gold, and the self-attribution bias. Take it away, Chris.
Thanks, Adam, and welcome everybody. For those of you on this webinar, you get a sneak peek of my new suit that I'll also be featuring on BNN next Tuesday at 1 p.m. So tune in then for more information and to see the pants that accompany this suit. As Adam alluded to, Too Hot to Touch is a play on the fact that Jerome Powell and the Federal Reserve came out, or I guess not even came out, just expectations following hotter than expected inflation numbers this month or this week have cooled their rate cut expectations from 2 to 3 prior to that to down to just less than 2. This is something that we've been discussing with you all on MSOM for the course of this year. I believe we came into the year with about a six cuts or 1.5% total coming out of the overnight lending rate in the United States over the course of 2024. We thought that was too low, and we have been expressing that view in different ways inside of the fixed income component of our portfolios. We have reduced our overall credit in those portfolios because of this, because credit spreads have really come in quite tight. We don't feel like we're getting paid to play that game at the moment, and we're actually going to be discussing this further in our investment committee meeting on Monday, whether we should pivot further in that direction and looking at the mortgage-backed security market, which does have a bit of a higher yield over treasuries, but implicitly is backed by the U.S. government through the programs they have there. Couple reasons inflation has been heating up. Job growth in the United States. We saw 303 jobs added last month, shattering expectations of 200,000 in the month of March stateside. That coupled with wage growth is making it harder for companies to keep up with the Joneses and having to pay to keep those people happy, which is flowing through into the cost of goods sold, which throws through to that basket of goods that consumers are buying, i.e. inflation. However, here in Canada, it's not quite as rosy of a story. We actually saw the unemployment rate rise to 6.1 with a net 2.2 thousand job loss in the month of March. That's not fantastic and a sign of the differentiated dichotomy between both of our economies. And so we think that there is the possibility that the Bank of Canada actually leads this rate cut regime. It probably won't want to outpace the U.S. too much because that would not be great for the loonie. That's another topic that we'll be discussing on our investment committee next week, and may impose changes to our portfolios somewhere in the likes of rotating some of our dry powder that we are making a nice handsome 5% plus yield on to US dollars to try to capture potentially an FX opportunity that we're seeing brewing there. On the positive note for our economy has been a move higher in oil prices. I'll dive into this a little bit deeper, but that again does not help with the inflation conundrum because of the cost of transportation and manufacturing rolling through into the price of goods sold. So with a weaker economy and inflation expected to hit the Bank of Canada's target by 2025 and falling from 2.8% last month down to likely the low twos by the end of the year, wouldn't be surprised to see the BOC move first on that side. However, the show goes on. Equities are rocked higher in March, up 3.2%. Stateside 4.1 here for the TSX, albeit we haven't kept up with their double-digit gains so far in the first quarter. Those high interest rates are starting to bleed through company earnings. 2 years ago, S&P 500 companies paid about $50 billion in every quarter in interest expenses. That's up 40% to 70 billion, and likely to continue as some of that fixed term debt matures and is refinanced at these higher rates. We've been long the energy trade. We added a position in the Canoe Energy Income Fund back in Q4 of last year, around September. That's doing well as you'd expect with prices moving higher. Pardon me, I'm coming down with a bit of a cold. And so that's a positive for the Canadian economy. We've seen a great rally on the back of our energy holdings, Topaz, Oxy state in the United States, and then again the fund that we hold for a lot of our clients, all doing fantastic this quarter, and a trade that we continue to lean on. I would say likely potentially lightening up should we get sustained prices in the 90s. We think that's kind of the upper band of the medium-term trading range, and a price that likely gets the attention of OPEC plus the United States to try to intervene and not let it go much higher than that level. This is happening for a few reasons. One is just a supply-demand mismatch. We really underinvested in the energy exploration and production assets as there was this looming change to green technology, which is happening, but I think is going to just take much longer. And I think it's one of the best opportunities for us as investors in our potential careers with how obvious this trade is, that we're moving in that direction. I don't think we get to that quickly, and I don't think that we reverse course and think coal is the solution in 10 or 15 years from now. So opportunities in nuclear, small modular nuclear reactors, natural gas, fantastic low-hanging fruit that all play space into that, as well as things like copper. We own Freeport-McMoRan, one of the largest copper miners in the world, doing fantastic right now with the price of copper moving up above $4. I digress slightly. Other opportunities we've been noticing out there is a pick back up in the Chinese economy, third consecutive month in expansion mode on the manufacturing index. That's been a concern of ours that looks like we've gone through the worst of it. And then lastly, this is something I was just discussing with one of our clients, is that this rally's been fueled by multiple expansion. If you look at this chart on the bottom right, that's earnings growth of the S&P 500. Last year, earnings growth was 0% from 2022. The market was up nearly over 20, 25 roughly percent, I can't recall, but huge gain. All of that is people willing to pay more for a dollar of earnings this year than they did last year. That cannot go on forever. We need earnings growth, and you could see this by consensus estimates. We're expecting 11% earnings expansion this year, followed by 13 next year. So if people just remain in the same bucket of paying as much as they do today for a dollar of earnings in a year from now, markets do have room to move higher, and something that is encouraging us to maintain long positions. One of the moves we made following our investment committee meeting last month was expanding our position in the gold mining, in particular gold mining sector, by adding a position in Agnico Eagle Mines. This fantastic tier 1 operator has both streaming contracts and some exploration assets it owns itself. We trimmed a little bit of our Barrick position and sold a position in Acon, an industrial company that had done well for us, and took the thesis that gold equities had not been keeping up with the commodity, which is now at and around all-time highs at about $2,300 US an ounce. That's really profitable for a lot of miners and should be good for the stocks. This chart on the bottom left is an interesting one that we keep an eye on. This is the ratio of the gold price to the gold miner index. You could see that, one is kind of your mean reversion. There's times where the miners do better than the commodity. There's times where the commodity does better than the miners. And we're pointing out here these times where you've seen this big disconnect where the commodity's done way better than the miners, and what happens following that. it tends to be quite the breakout for the mining stocks. And so we thought it would make sense to add to those positions, and something that I'm happy to touch on. If anyone has any questions, feel free to put them in the chat and we could reach out and have a conversation about it. But I think there's a great opportunity here in the gold mining sector. And for our Canadian dividend focus fund, we're pretty limited to the options there. I think you actually get even bigger juice from some of the smaller exploration and production companies. I think you go down too much to those people that are poking holes, and it's still a dice roll. But I think if you're for individual investors, there could be opportunities in some other mining assets. I'm heading to Arizona in a little over a week for a mining conference to explore more opportunities in not only gold but other precious metals and industrial metals as well. This rally in the commodity has been fueled, one, by inflation, which continues to be persistent, as we've talked about, as well as central banks around the world really adding to their gold reserves. Between China, Poland, and Singapore last year, they added 430 tons to those reserves. So again, a supply demand aspect, and a lot of gold's use is just in being a hedge against inflation, coupled with a safe haven asset and a fantastic diversifier for a traditional portfolio of assets, and a reason why you'll likely see us always with some sort of exposure to the asset class, just in varying weights based on fundamentals and value of the commodity. But with where gold prices are, we think this trade has fortuitously been working out quite well and still has some room to run. But I would say if it did go pretty hot, we'd likely take out one of those miners and just stick with one horse in that race. Lastly, dividend stocks have significantly lagged the overall market, particularly here in Canada, with the TSX doing 13% last year. The TSX dividend index was only up 3%. This tends to ebb and flow, and interestingly enough, dividend stocks tend to be outperformers versus non-dividend stocks in most periods of time. This hasn't been the case for the past 2 years. It's been an AI frenzy, a meme stock craze, and a lot of go growth-oriented trades leading the way, with your telcos and your utilities down, significantly over the last year in the face of broad markets, being up double digits and stateside mid-20s. That has us poking around actually in telcos and possibly utilities of doing some sort of a structured product where we could take a outcome based approach and basically say we believe that telecom stocks in Canada will be higher at some point in the future, and we can take kind of a levered bet on that with some downside protection. So stay tuned for how we're going to express that view and potentially place that into our client accounts. We're just waiting for a bit of a bout of volatility. You tend to get better options when that happens. And also volatility brings downside to prices. So we're buyers when people are getting fearful, and we think that there's a great opportunity there. That actually leads well into the next little behavioral finance tidbit for this week or this month, which is the self-attribution bias. This is something behavioral scientists recognize, that investors tend to over-attribute their skill when things are going well, and on losses, blame factors outside of their control. If you've ever done what we do on a daily basis, I'm sure you fall victim to this as well. The biggest risk to this is something called overconfidence bias, which has people piling in. You could, where I'm located right now doing due diligence, everyone was joking last night about, thanks NVIDIA. Like, these are, normal, like, just the diverse group of people that not even investors, and everyone's talking about NVIDIA. 2 years ago, no one would know what NVIDIA is, or let alone what they do. And so that type of self-attribution bias, like I said, can lead to overconfidence and also create negative outcomes. Dalbar, a great research institute, they put this out every once in a while, but basically over the last 30 years, the S&P's returned over 10%, but the average investor is closer to 7%, and that's just from people coming in at the highs and going out at the lows. It's a dangerous combination. One of the best ways to mitigate this is work with a trusted advisor, whether that's at Team LWC or otherwise. Obviously, we do quite a good job here, and we have a lot of happy clients that could attest to that. And take a disciplined approach, understand these biases, and minimize them in your investment approach. With that, I will wrap things up and pass it over to Adam to see if we had any questions come in.
Thanks so much, Chris. Yeah, we just had one question come in, and it's on Bitcoin. We've seen Bitcoin prices go crazy recently. With the halving event coming up soon, what are your thoughts on its future?
We've held a position in a Bitcoin ETF where Canada was actually a first mover in that space. Kudos to my old partners at Purpose Investments. And we've had that in our portfolios since I started just over 2 years ago. It's been a fantastic contributor to our performance. Prices were suppressed back in September. We added to that position when the currency was trading around 23,000 US dollars. And then most recently, we actually trimmed some of that last month, right around 70,000, about where it is today. Actually, probably a little higher than it is today, but it does move quite a bit. And so it's similar. It's digital gold in a lot of ways. It provides that value of safety, diversification. There's a finite number of Bitcoin that will ever be produced, 22 million of them, and an infinite number of US dollars or Canadian dollars that could be produced. You just need to hope that people continue to have confidence in the governments backing those currencies. And so when you price Bitcoin in those currencies, as that supply grows and the supply of Bitcoin remains stagnant, it just makes intuitive sense that the price will rise. Not to mention that in other parts of the world where currency stability basically doesn't exist, y mi asocios en Argentina y Venezuela is a really challenging part and a place of a store of value for those people in those countries to defend their savings, not only against inflation, but against the devaluation of their local currency. For those reasons, we think it's a good asset class. Again, on our investment committee next week, we will actually be discussing a switch from Bitcoin or partially out of Bitcoin into Ethereum, as we've seen a near-term dislocation between those two cryptocurrencies, and believe that the launch of Ethereum ETFs is pertinent or pending in the United States, which should bring more investors into that asset class. This halving, as the last several have produced tremendous rallies in the currency. But much like an earnings report, it can go either way. So with that dry powder from our recent sale, if we did see an opportunity, we'd probably deploy back to a slightly higher weight in our portfolios and take advantage of that weakness, as we think that there's still upside, but just try to be a little bit more, you need to be a little more active with some of these more volatile asset classes or securities.
That's great. Thanks so much, Chris. So those are all the questions that came in today. Thank you so much for joining us today on behalf of Team LWC. Thank you for your loyalty and trust in us. To keep up to date with the latest from Chris and the rest of the team, please follow Team LWC on LinkedIn. Have a great rest of your day, and looking forward to seeing everyone again soon. Take care.